Hi everyone, welcome back. Now in this session, we are going to cover bond valuation for CA final in a summarized manner. Now, if I ask you a general question, let us say you're going and buying a house as an investment, not for self-use, but you're buying it for investment. Now, how much are you going to be willing to pay for the house? The obvious next question that you will ask me is, what is the rent that I will actually get? Because if you want to buy a property as an investment, you will first see what is the return I'm getting, what is the benefit that I'm getting out of buying the property. Therefore, the value of the property is a function of how much rent you're going to earn. Similarly, the value of any asset for that matter is going to be a function of the benefit that you're going to get from the asset. How much you pay for an asset is going to be a function of how much you're going to get as a benefit from the asset. Similarly, in case of bond, the value of a bond is the present value of the future benefit that you will get from the bond. Now, what is the future benefit that you're going to get from the bond? One, you will receive coupon in the form, one, you will receive cash flow in the form of coupon, and two, you will receive cash flow at the end of the bond or in the maturity of the bond, which is called as maturity value. Therefore, the value of a bond is going to be function of the coupon that you're receiving and also the face value or the maturity value. In all the examples that we will do, the face value and maturity value are going to be equal. In real life, can both of them be different? The answer is yes. Maturity value can be either greater than or lesser than face value. But in all the questions that we are going to do from an examination point of view, we are going to assume that face value and maturity value are the same. Therefore, the intrinsic value of the bond is the present value of the future cash flows. Now, why are we doing a present value? Because you are not receiving coupon tomorrow. You will be receiving coupon 1 year later or 2 years later or 3 years later. Similarly, you will receive the face value or the maturity value not tomorrow, but you're going to receive it after the maturity of the bond, which is say 3 years from now. Therefore, there is a need for discounting it, and the intrinsic value is the present value of all these future cash flows. Now, when the concept of discounting comes, we need to find a discount rate as well. At what rate are we actually going to discount these cash flows? Now, this rate of return is called as the required rate of return. If you remember, under capital budgeting in CA Inter, under capital budgeting, we used to use the required rate of return as the weighted average cost of capital. All right, what we used to do over there was that we used to find whether a project is viable or not, and for that we used to use the required rate of return as the weighted average cost of capital. Why was the required return weighted average cost of capital? Because that is the cost that the company is incurring. All right, that was the cost of capital that the company is incurring, and therefore the company, for it to invest in a particular project, it needs at least a minimum return equal to WACC. Now, in this case, I will tell you how we find out the required rate of return a little later. But for now, remember that the required rate of return is supposed to be used as the discount rate. And what is the required rate of return is again a function of how risky a bond is. All right. If the bond is having a greater risk, then higher will be your required return. All right. Higher the risk, more will be your required rate of return. Higher the risk, more will be the required rate of return. Now let's just think, why higher the risk, higher the required rate of return. I am giving you two options. All right. One option is you go and invest your money with State Bank of India, and State Bank of India will give you 7%. All right. You have got two options. First option, you go to State Bank of India and invest your money at 7%. Option number two, you give your money to me and I will also give you 7%. State Bank of India giving you 7%. I am also giving you 7%. What will you decide? All right, you will definitely go and invest your money in State Bank of India. Reason being, State Bank of India is much more reliable than me. All right, you do not know, if you invest your money with me, you have no guarantee whether you will receive your money back from me, whereas with State Bank of India you have certain level of guarantee that you will actually receive your money back. All right, so therefore, if you have to invest your money with me, I have to induce you. If you have to invest your money with me, I have to induce you. Therefore, what I will say is, if you give me your money, I will give you 10%. State Bank of India is giving you 7%. I am willing to give you 10%. All right. Reason being, I am more riskier. I agree with that fact. And therefore, to induce you to invest with me, I am giving you a higher return. All right. So therefore, that is the reason I made that statement. Higher the risk, more is the required rate of return. From your point of view, you need a higher return from me. Your required rate of return is more from me rather than from the State Bank of India. That is the reason higher the risk, greater is the required rate of return. Lower the risk, lower will be your required rate of return. So required rate of return has got two components. One, the risk-free rate, which is the basic rate that you need after investing, even let's say in the most risk-free security. This is the return that you want by investing, let's say, in the Government of India bond. That is the risk-free rate. The more discussion on risk-free rate will happen in portfolio management, but for now, risk-free rate is the minimum rate that you need even for investing in a risk-free bond. Risk premium is the additional return that you need for investing with a risky person, for additional premium that you need, or the additional return that you need for investing with a risky person. Now let's take a quick example to see how we calculate the intrinsic value of a bond. Now, in the example, I am saying that the face value is $1,000. When I say face value is $1,000, it also means that the maturity value is $1,000. The coupon is 6%. Required rate of return is 7%. All right. Coupon is nothing but the cash flow which the company is going to give you. Your required rate of return based on the riskiness of the company is 7%, and the maturity is 5 years. All right. 5 years from today, the bond will mature. All right. So if you think of it, you are going to receive $70. How did I calculate? Sorry. Now, if you look at it, you are going to receive $60 as coupon. How did I calculate $60? 1,000 multiplied by 6%. Every year, you will be receiving $60. Year one, you will receive 60. Year two, year three, year four, you will receive $60. Year five, you will receive the coupon of $60. But over and above that, you will also receive the face value or the maturity value of $1,000. So in year five, you're going to receive $1,060. Year one to four, 60, 60, 60, 60, and year five, you will receive $1,060. Now, what I said is if you want to find the intrinsic value of this bond, you have to calculate the present value of all these cash flows. You have to calculate the present value of these cash flows. The discount rate is going to be 7%. Discount rate is your required rate of return, which is equal to 7%. All right. So I have prepared. This is how you will also present in the ICI examination. So here, nature of cash flow, which means either the cash flow can be coupon or the cash flow can be face value or maturity value. And what is the amount of cash flow? Then the present value factor, and the DISCF is the discounted cash flow. All right. You should write discounted cash flow in the exam. I am going to write DISCF. All right. So year one to five, it is an annuity. If you think of it, year one to five is a $60 annuity. All right. So I've written years one to five, coupon $60. Year five, I am receiving face value or maturity value of $1,000. And then I've calculated the present value factor, which I'm not going to teach you. And then discounted cash flow is nothing but cash flow multiplied by present value factor. All right. So $60 received at the end of each year from one to five is equal to $246 today. All right. If I receive $60 at the end of year one, two, three, four, five, the present value or the value of such $60 today is 246.01. Similarly, the value of $1,000 that I'm receiving after 5 years is valued at $713 today. All right. The value of $1,000 received after 5 years is equal to $713 today. The value of the bond as a total is the present value of both this coupon and this face value. All right. So I am taking the sum of this discounted cash flow, which is equal to 959. 246 plus 713 is equal to 959. And this is nothing but the intrinsic value of the bond. This is nothing but the theoretical value. All right. This is not equal to the market price. On the NSE exchange, you will not see this as the market price necessarily, but this is a theoretical value. This is a value on a piece of paper that you have calculated. All right. Also known as intrinsic value, which I will refer to as IV going forward. All right. So the intrinsic value of the bond is $959. The features of the bond were the face value $1,000, coupon 6%, your required rate of return was 7%, and the discounted cash flow came to $959, which is nothing but the theoretical value or the intrinsic value of this particular bond. All right, now if you carefully look at it, this intrinsic value was purely a function of the fundamentals of a bond. All right, this intrinsic value is purely a function of the fundamentals of the bond. By fundamentals, I mean one is the cash flow, the second is the risk. When I say risk, I'm calling it risk because risk is what going into the required rate of return. What is going into the required rate of return is actually nothing but risk, right? So it is purely a function of the fundamentals, which is cash flow and the riskiness of the bond. Whereas the market price is not necessarily purely a function of the fundamentals of the bond. The market price also has got many other aspects to it. All right. The market price is primarily determined by the demand and supply. What drives the demand and supply? Of course, one of the reasons is one of the things that drives demand and supply is the fundamentals. All right. But beyond fundamentals, there are many other things which come into play when you're seeing the demand and supply. All right. So market price is actually driven by demand and supply, whereas the intrinsic value or the theoretical value is purely driven by fundamentals. All right. Both of them need not necessarily be the same. $959 is something that you have calculated with a pen and a paper, which is not necessarily what you see on the trading screen as the price of the bond. All right. Of course, demand and supply, one of the primary factors that drives demand and supply is the fundamentals, but there are more other factors which also drive the demand and supply of it. Now, if let us say hypothetically, if in the market this bond is selling at $930, you went and saw on the National Stock Exchange that this price is actually trading, this bond is trading at $930. All right, you calculated the value as 959. It is trading in the market at $930. What will you do? All right, you should jump and buy the bond because you have something in your hand which is worth 959, but it is available at 930 only. All right, for example, iPhone 14. All right, iPhone 14 actual cost is 1 lakh, but somebody is selling it at 80,000. What will you do? You will jump and buy, right? Because something which is worth 1 lakh is being sold at 80,000. Similarly, over here the intrinsic value of the bond or the theoretical value is 959, so it is being sold at 930. Therefore you have to go and buy the bond. All right, buy the bond in the market because the bond is available cheap in the market. All right. So if the intrinsic value of the bond is greater than the market price of the bond, if the intrinsic value is greater than or equal to the market price of the bond, then you buy the bond because it is available at cheaper rate in the market. If the intrinsic value of the bond, let us say 759, and the market price is 980, the market price is 980, you have something which is at 959 available in the market at 980, then you should actually sell the bond. All right. For example, if there is a worthless car and somebody is willing to actually buy it at 2 lakh rupees, then what will you do? You will immediately sell it off, right? Same way, this bond is worth, I won't say bond is worthless, this bond is worth 959, but it is available in the market. Somebody is willing to actually buy the bond at $980, then go and sell the bond. Go and sell the bond immediately. If the IV of the bond is less than the market price, IV of the bond 959, market price 980, then sell the bond because it is costlier. Costlier is also referred to as overpriced in the market. Cheaper is referred to as underpriced. Costlier is referred to as overpriced. All right. In the market, it is more heavily priced or overpriced. All right. Okay. Now, if you carefully look at it, if I increase the required rate of return, if let us say I increase the required rate of return, let us say if I increase the required rate of return to 10%, what will happen is this value will actually go down. This value will actually come down. All right. Higher the required rate of return, the lower the intrinsic value of the bond. You can do it at your end, increase this discount rate to 10%, and then you will see that the discounted cash flow is actually falling below 959. The value or the intrinsic value will fall below 959, and therefore higher the required rate of return, lower is the price of the bond. Higher the required rate of return or the discount rate, lower will be the price or lower will be the intrinsic value of the bond. Okay. Okay, now in the above illustration, we've assumed that the bond is actually paying coupon on a annual basis. All right, it's paying coupon at the end of each year. Now, there can be few bonds, especially corporate bonds, which actually pay coupon every 6 months. All right, there can be corporate bonds which pay coupon every 6 months. So now, in that case, what would you do? All right, if the information is given in the same way, all you have to do is consider the coupon to be actually $30 and also divide the required rate of return to 3.5 percentage. All right, the required rate of return was 7 percentage per annum. You divide it to 3.5%, divided by 2 to get 3.5 percentage, and you can proceed in the same manner. All right, in that case, your number of periods will actually be 10 periods. All right, because you're going to have coupon at the end of year 0.5, 1, 1.5, 2, 2.5, and so on. So the total number of rows, or the total number of periods that you're going to have is 10 periods, wherein each cash flow will be $30, and the discount rate that you will actually use is 3.5 percentage. All right, but you'll have to use for 10 years. All right, you'll have to use 3.5 percentage for 10 years rather than one single year. All right, similarly, if let us say the bond pays coupon quarterly, then you divide the required rate of return by 4, and you also divide the coupon rate by 4. All right, so your coupon will then become $15. $60 on a per annum basis is equal to $15 quarterly, and you also do 7 divided by 4, and whatever the number is, 1.75 percentage will become your discount rate, and in the number of years, your annuity will then be 20 periods. 5 into 4, your annuity will actually be for 20 periods, and you have to calculate the discount rate accordingly. You'll have to calculate the present value factor for 20 periods. All right, that 1.75 should be calculated for 20 periods. All right, so that is how you would actually do in case you're actually having a bond which pays coupon semi-annually or which pays coupon on a quarterly basis. All right. Now, in the above example itself, we had an IV of $959.01. All right, we had an IV of $959.01. Now, let us say over here the maturity was 5 years. Let us say 1 year has passed by. 1 year has actually passed by. Now you have only 4 years for maturity. Now you have only 4 years left for maturity. What I want you to do is calculate the intrinsic value for 4 years. All right, how it would be is you would have coupon for another 4 years, which is equal to at the rate of $60 for 4 years, and at the end of fourth year you will have a face value of $1,000. All right, so 1 year has passed by. Years, number of years remaining are 4, so therefore the coupon you will receive for the next 4 years, and the face value you will receive at the end of fourth year. Calculate the discounted cash flow. I have already done it, but not in the form of table. The intrinsic value or the discounted cash flow will be equal to 966.13. All right, the intrinsic cash flow is equal to 966.13. If you notice, it was earlier 959.01. It has now increased to 966.13. All right, it has increased to 966.13. Let one more year pass by. Now you will have only 3 years of coupon left, and you will have face value that you will receive at the end of third year itself. All right, again calculate the intrinsic value. Cash flows for the next 3 years of $60. Coupon, it's a face value of $1,000 at the end of third year. The intrinsic value will be 973.76. The intrinsic value will be 973.76. Let us say another 2 years pass. All right, so from 5 years now, totally 4 years have passed by. Out of 5 years, 4 years have passed by. You are now left with 1 year. Now you will receive $60 at the end of year one, and you will also receive $1,000 at the end of year one. All right, so you're going to basically receive $1,060 at the end of year one. If you calculate the present value at 7% again, you will get an intrinsic value of $990.65. You will get an intrinsic value of $990.65. Let us say another 1 year has passed by. All right, so basically you're just standing 1 minute before the maturity. All right, you're going to receive maturity value in the next minute. You've already received coupon. Now you're going to receive the maturity value just in another, let us say, instead of 1 minute, let's say you're going to receive it in the next half an hour. All right, you have received the coupon of $60. You're going to receive the maturity value of in the next half an hour. The present value of the bond will actually be $1,000 discounted to today. $1,000 that you're going to receive after half an hour, you have to discount it to now. It's obviously going to be equal to $1,000 itself, right? Because you're standing almost right at the moment. All right, something that you're going to receive after half an hour, the present value of that amount will actually be equal to $1,000 itself. All right. So if you're standing basically half an hour away from maturity, your face value or the intrinsic value of the bond will actually be equal to the face value of the bond itself. All right. So your intrinsic value will be equal to $1,000. All right. So if you carefully look at it, it was 959.01 when I was standing 5 years away from maturity. It slowly started increasing. If you carefully look at it, it has started increasing from 959 to 966, 966 to 973, 973 to 990, and then from 990 it has increased to $1,000. So everything else remaining constant. All right, and my emphasis is on this. Assuming that everything is remaining constant, what have I kept constant? The discount rate have not changed. I'm assuming that your required rate of return at the end, when the bond was 5 years away from maturity, was 7%. When the bond was 4 years away from maturity, also your discount rate or the required rate of return is 7%. 3 years, 7, 2, 7, and so on. All right, I'm assuming that your required rate of return is 7% throughout. Everything else remaining constant. As a bond reaches its maturity, the bond's price, although I've used the word price here, what I mean is the bond's intrinsic value tends towards its maturity value. All right, the bond's intrinsic value tends towards its maturity value. From 959, it was moving towards its maturity value of $1,000. All right. This is not only true for a discounted bond. What do I mean by a discounted bond? A bond which is trading at less than its face value is called as a bond trading at discount. All right. This is the 959.01 is less than its face value. So therefore, this bond is called to be trading at a discount. It's trading at a discount to its face value. There could be also few bonds which are trading at a premium, which means they're trading at a premium to the face value. Your face value is $1,000. The bond is trading at $1,020. That's called as trading at a premium. All right. Whether it is a discount bond or a premium bond, a bond's intrinsic value will always tend towards its maturity. In case of a discount bond like this, you saw that the bond's intrinsic value is actually increasing. 959 to 1,000, it is increasing. Whereas in case of a premium bond, the bond's price will keep decreasing. From 1,020, it will come down to 1,010, 1,005, and then it will touch 1,000. All right. So it will keep decreasing in case of a premium bond and increasing in case of a discounted bond. All right. So whether it's a discounted bond or a premium bond, the intrinsic value as time progresses will tend towards its maturity. All right. But in the example, I have kept everything else remaining constant. I have not changed 7%. I have kept the discount rate constant. All right. Hypothetically, if I would have kept the discount rate as say 10 percentage of, all right, if the discount rate at the end of year one, if it has changed from 7 to 10, then since the discount rate has gone up, the bond price or the bond intrinsic value will fall. All right. Although our expectation is that the bond intrinsic value should go up, since I have increased the discount rate, the bond's price or the intrinsic value will fall. Therefore, this constant increase for a discount bond or the constant decrease for a premium bond will hold good only if everything else remains constant. All right, meaning the required rate of return, if it is kept constant, then you will have a continuous increase in case of a discount bond and a continuous decrease in case of a premium bond. All right, that's it for this lecture. Thank you guys. Bye bye.